Investors often compare midstream energy infrastructure with the utilities sector. On the surface, they have some things in common. They're both concerned with delivering energy to customers. They both invest in infrastructure, hard assets that are tangible. But in terms of performance and outlook, they couldn't be more different. Midstream went through a period of big spending related to the shale revolution 5 to 10 years ago. We needed more pipelines to get new supplies of natural gas and oil to market. But in recent years, CapEx has fallen. There are two reasons for this. One is that we mostly have the pipeline network we need. The other is that court challenges by climate extremists have added tremendous uncertainty and cost to any new construction project. The Mountain Valley Pipeline, built to move natural gas from West Virginia to Virginia, is an example. After years of delays, it required an act of Congress to get it completed. Nobody wants to go through that again. So companies are spending less. The result is that free cash flow for pipelines has grown. $1 not spent on new projects is $1 for dividends, buybacks, or debt paydowns. Remember, if you meet a climate extremist, give them a hug and offer to drive them to their next protest. They have helped boost the sector's free cash flow, which now yields 9.8%. By contrast, utilities are spending more. They're in the middle of the energy transition. They're spending on new wind power and solar farms. These typically last 20 years or so, less than the 40-year average life of a coal-burning power plant. Pipelines can last 60 years or more. The midstream sector owns longer-lasting assets. Utilities are also having to add backup power solutions to make up for when it's not sunny or windy. The more we rely on intermittent power, the more we need redundancy for when the weather doesn't cooperate. This is pushing CapEx for utilities higher. Democrat politicians like to say this will cut prices because solar and wind are cheaper than reliable energy like natural gas. Meanwhile, utilities are going to need rate hikes in order to earn a return on their increasing capital investments. The result is that today utilities have a negative free cash flow yield of around minus 2.5%, far from the positive 9.8% free cash flow yield of pipelines. Because of their better cash flow, pipelines offer a dividend yield of 5.8%, while utilities are only 3.3%. And that's with midstream paying out only 60% of profits versus 70% for utilities. Debt to EBITDA is a common measure of leverage. On this metric, pipelines are less risky at 3.9 times, whereas utilities are 5.2 times. Utilities are expected to deliver the energy transition. They're now the ones facing environmental opposition to wind and solar farms, as well as the high voltage transmission lines necessary to move power. Solar and wind need a lot of room, so they're situated far from population centers. On every measure, whether it's free cash flow, dividend yield, leverage, or CapEx, midstream energy infrastructure beats utilities. That's why they've outperformed so strongly over the past 3 years. When it comes to the energy transition, it's pretty clear that you don't want to invest in the companies that are spending money providing it. Whether it's the S&P Global Clean Energy Index, offshore wind power companies, or utilities, you don't want to be providing financing to the companies that need to pay for a lot of new projects. That's what makes midstream energy infrastructure so attractive and utilities so unappealing. If you're interested in learning more about the energy sector and interest rates, then don't forget to subscribe and follow us on LinkedIn and Twitter. Our handles are in the description box below. To find out more about what we're thinking, you can sign up for our twice-weekly blog at sl-advisors.com. We always love to hear from you, so if you have any comments or blog ideas, please leave them down below. I'm Simon Lack. Thank you for watching this video.